Yeah, the 1-2 punch of ADP coming out double the expectation, more than double the expectation, and 3.7% personal consumption just goes to this feeling, are we not seeing the strength in the U.S. economy that keeps surprising to the upside? That economic surprise index, that's what I was pulling up right now. We could see it continuing to climb to the highest level going back certainly to earlier this year, going back to April of this year. So it raises this question, are we also underestimating what we could potentially be getting on Friday or, amid the noise? Also what we get tomorrow with core PCE, because the core PCE also came in just slightly higher.
So this is why it's so difficult to try and understand, trying to unpack what is driving bonds here. The data, just a series of upside surprises, to your point, Citi going all the way back to April, or the politics. And the reason matters, and this was really the essence of Mohammed's piece yesterday on Bloomberg Opinion. He said the following: while most analysts agree on the list of potential contributors to this unusual development, there is little consensus on their relative importance. This matters for what we forecast about the future well-being of the economy and the sustainability of this year's impressive stock market performance. Are yields higher for good reasons, everything we just discussed over the last 15 minutes, or for bad reasons, worries about deficits and big sweeps leading to more debt?
And until we have clarity on that, do we just see the two markets trading to their own music? And that's essentially the question that Jack Coffrey was trying to unpack. And a real question here about higher yields in and of themselves can't torpedo stock market valuations if people can ignore the potentially bad reasons that they could be potentially rising.
But with ADP and GDP, we've got reason for people to bet on the strength of the economy. Although the headline number was a little lower than anticipated, personal consumption, as we mentioned, is very high. But business investment is also strong, 3.3%. That's down from 3.9%, but it is still relatively strong for non-residential private investment. Structure's down 4%, and that was forecast because we had a lot of structure building, factory building. Now people are buying this stuff to put in those factories, with equipment purchases up 11.1%. The real difference here is in what we saw in trade. Imports were up by 11.6% of goods. What's interesting is they don't really show up in inventory, so we're not sure where they are at the moment. Inventory is 60.2 billion, and that should mean strength in the fourth quarter. Government spending was up 5%. National defense, a large part of that, up 14.9%. We're sending a lot of stuff to Israel and to Ukraine, so we're buying a lot of stuff like that. But then the final line you'd look at is final sales to domestic purchasers, gets rid of the inventory and trade numbers in there, and we're up 3.5%, which is the strongest since last year.